The Panic of 1837. Imagine building a nation from scratch. America in the early 1830s was drunk on possibilities and drowning in credit. After President Andrew Jackson killed the Second Bank of the United States in 1832, states unleashed a banking frenzy, printing money backed by little more than optimism. Land prices quadrupled and cotton exports boomed until the inevitable crash came on May 10, 1837, when New York banks suspended specie payments, refusing to exchange paper money for gold or silver. The financial house of cards collapsed spectacularly. Unemployment hit 25% in some cities, while land values plummeted 75%. Farmers lost generations of family property, urban workers crowded into soup kitchens, and the nation's 850 banks failed at an alarming rate. After nearly 40% of American businesses failed during this 5-year economic nightmare, Congress finally passed the Bankruptcy Act of 1841, America's first acknowledgement that sometimes debts simply couldn't be paid. As the nation limped towards recovery, few could imagine that just 3 decades later, an even more devastating crash would sweep across not just America, but the entire industrialized world. The Panic of 1873. While America was still absorbing the devastating lessons of 1837, an even more destructive economic typhoon was brewing. The Panic of 1873 erupted when America's aggressive railroad expansion, consuming nearly $1 billion in investment capital, collapsed with the failure of major banking house J. Cook and Company on September 18, 1873. The New York Stock Exchange suspended trading for an unprecedented 10 days, while 89 railroads defaulted on their bonds and over 18,000 businesses closed their doors within 2 years. This wasn't merely an American disaster, it unleashed what economists would later call the Long Depression, lasting over 5 years. Farm prices plummeted 45%, driving thousands of families into destitution. Labor unrest exploded with the Great Railroad Strike of 1877, where federal troops killed over 100 protesters. President Grant, demonstrating the economic sophistication of a brick, vetoed an inflation bill that might have provided relief, insisting on maintaining the gold standard despite widespread suffering. While devastating, this panic would pale in comparison to the cataclysm that would shake the foundations of global capitalism just 56 years later. The Great Depression. The Roaring Twenties ended not with a whimper, but a deafening crash when the stock market collapsed spectacularly in October 1929, erasing $30 billion in value, nearly twice the entire federal budget. What followed wasn't just a recession, but the Great Depression, an economic apocalypse unmatched in American history. By 1933, industrial production had been cut in half, home building dropped by 80%, and unemployment soared to a staggering 25%. The banking system imploded as 9,000 banks failed, taking with them $7 billion in deposits, the life savings of millions of Americans who had no government insurance protection. Homeless encampments called Hoovervilles sprouted across America, mocking the president who insisted prosperity was just around the corner. The Dust Bowl transformed America's heartland into a wasteland, sending desperate Okies west in search of mere survival. Farm foreclosures reached pandemic levels, sometimes met with armed farmers preventing auctions. Only when Franklin Roosevelt introduced his radical New Deal would America begin the slow climb back toward economic stability. But even his bold programs couldn't prevent another sharp downturn in 1937. The oil crisis recession, 1973 to 1975. America's post-war economic party screeched to a halt when OPEC nations, furious over U.S. support for Israel in the Yom Kippur War, orchestrated an oil embargo that quadrupled petroleum prices virtually overnight. Gas stations displayed "Sorry, no gas" signs as Americans endured hours-long lines for fuel that had jumped from 30 cents to over $1 per gallon. This wasn't just an inconvenience. It was economic warfare that exposed America's dangerous dependence on foreign oil. The stock market lost 45% of its value, while unemployment doubled to 9%. Perhaps most alarmingly, a new economic monster emerged: stagflation, the previously impossible combination of high inflation, reaching 12%, and stagnant economic growth. President Nixon's price controls backfired spectacularly, creating shortages of everything from toilet paper to sugar. The crisis permanently ended America's post-Recession economic golden age, shattering the assumption that prosperity would continue uninterrupted. Yet, even this painful recession would be overshadowed by the deliberate economic shock therapy administered by the Federal Reserve just 6 years later. The early 1980s recession, 1981-1982. America's inflation nightmare reached its terrifying peak at 14.8% in 1980, prompting newly appointed Federal Reserve Chairman Paul Volcker to administer economic chemotherapy, deliberately inducing a recession to kill inflation. His weapon, raising interest rates to an almost unimaginable 20%, making mortgages unaffordable, and crushing businesses dependent on credit. The treatment worked, but the side effects were brutal. Unemployment soared to 10.8%, higher than during the 1970s oil crisis. Construction and manufacturing sectors collapsed, with 30% of Michigan's auto workers losing their jobs. Farmers, already struggling, faced a full-blown crisis as equipment loans became unpayable and land values plummeted. The poverty rate jumped to 15%, the highest since the 1960s. President Reagan, despite campaigning on prosperity, stood firmly behind Volcker, absorbing intense political heat as protesters mailed keys to homes they could no longer afford to the White House. When the recession finally ended in late 1982, inflation had indeed been tamed, but at a tremendous social cost that would reshape American economic policy for decades to come. Yet even Volcker's harsh medicine couldn't prevent what would arrive 25 years later, a financial catastrophe so severe it would earn the ominous name the Great Recession. The Great Recession, 2007 to 2009. A financial tsunami began as a seemingly contained housing hiccup when subprime mortgage defaults rose alarmingly in 2000-2007. Wall Street had transformed these risky loans into supposedly safe securities through financial alchemy called collateralized debt obligations. When housing prices stopped their perpetual rise, the entire system imploded spectacularly. Investment banking giant Lehman Brothers collapsed in September 2008, sending global markets into freefall. The Dow Jones plunged 54% from its peak, erasing $16 trillion in household wealth. Unemployment doubled to 10% as 8.7 million jobs vanished. Foreclosures swept America like a plague. Over 6 million families lost their homes. Congress reluctantly approved a $700 billion bailout for banks considered too big to fail, sparking populist rage. Federal Reserve Chairman Ben Bernanke deployed unprecedented emergency measures that likely prevented a complete financial meltdown. The recovery proved painfully slow, reshaping American attitudes toward economic opportunity. Yet, an even more unusual economic catastrophe lurked just over the horizon, one triggered not by financial excess, but by a microscopic virus, the global financial crisis, 2008 to 2009. While Americans suffered through their housing collapse, the Great Recession quickly revealed itself as a truly global catastrophe. What began in U.S. mortgage markets spread like financial contagion across the world, because foreign banks had eagerly purchased those same toxic mortgage securities. Iceland's three largest banks collapsed spectacularly, and the tiny nation's stock market lost 90% of its value almost overnight. The United Kingdom nationalized major banks like Royal Bank of Scotland after injecting £500 billion in emergency support. European unemployment hit 10%, with Spain and Greece suffering rates over 25%, igniting protests and riots across the continent. China, fearing social unrest as 20 million migrant workers lost jobs, unleashed a $586 billion stimulus package. World trade contracted by 12%, the largest drop since World War II. The crisis exposed fundamental weaknesses in international financial regulation and the dangers of increasingly interconnected global markets. While central banks' unprecedented coordination prevented a 1930s-style depression, recovery would prove painfully uneven, setting the stage for new political and economic tensions that would soon manifest in the explosive COVID-19 economic shock. The pandemic recession, 2020. The global economy screeched to an unprecedented halt in early 2020 as an invisible pathogen forced governments worldwide to prioritize public health over economic activity. Street scenes from major cities resembled apocalyptic films. Times Square empty, the Paris metro silent, Tokyo's Shibuya crossing deserted. U.S. unemployment exploded from 3.5% to 14.7% in just 1 month as 22 million jobs evaporated, exceeding the total job losses of the Great Recession in mere weeks. The stock market plunged 34% before staging a remarkable recovery fueled by trillions in government stimulus and central bank intervention. Entire industries, Airlines, restaurants, hotels, entertainment faced existential crises, while others like video conferencing and e-commerce boomed. Congress approved the largest economic rescue package in American history, the $2.2 trillion CARES Act, including unprecedented direct payments to citizens. Unlike previous recessions, this economic shock was deliberately self-induced, a calculated sacrifice to save lives. As economies cautiously reopened, inflation surged to 40-year highs, sparking debates about whether we'd learned the right lessons from past economic catastrophes. Only time will tell if this unprecedented recession represents the beginning of a new economic era, or simply the latest chapter in capitalism's endless boom and bust cycle.